What if cheaper prices aren't enough to get people to buy used cars right now? That's exactly what's happening at CarMax. And today, I'm going to break down why this matters, not just for car shoppers, but for investors, and what it could signal about the broader economy. Here's what you need to know. CarMax, the nation's largest used car retailer, just posted a surprise drop in sales. Even after lowering prices, profits came in lower than Wall Street expected, and the company's stock, it took a nosedive. So, what's going on? Let's start with the basics. CarMax is a major player in the used car market, operating over 240 stores across the US. For years, it's been the go-to place for people wanting a car without that new car sticker shock. But in their latest earnings report, CarMax's average selling price dropped. Usually, lower prices mean more buyers. Not this time. In fact, total used car sales fell, and so did overall profits. Analysts had expected CarMax to earn more per car and sell more vehicles. Instead, both numbers missed the mark. CEO Bill Nash described the quarter as challenging, and investors reacted fast, sending the stock down sharply after the report. So, why did CarMax struggle, even with price cuts? There are a few big factors in play. First, let's talk about the consumer. Americans are facing higher interest rates. That means financing a car, new or used, costs more in monthly payments. Even if the sticker price is lower, the total cost to own a car is still up. This is squeezing budgets and making buyers pause. Then there's the bigger picture. After a wild ride in car prices during the pandemic, the market is still settling. Remember, just a couple of years ago, used cars were almost as expensive as new ones, thanks to shortages and supply chain chaos. Prices soared as people scrambled for available vehicles. But recently, supply has improved and prices have started to come back down. That should be good news, right? Well, not so fast. As prices drop, some buyers are actually holding off, hoping for even bigger discounts. It's a classic wait-and-see scenario. If people think prices will fall further, they're less likely to jump in today. That can stall sales even more. Add to that rising costs for everyday essentials, like food, rent, and insurance, and you've got shoppers feeling less confident about making big purchases. CarMax isn't the only company feeling the pinch. Across the auto industry, both new and used car sales have slowed compared to the frenzied buying we saw a couple years back. Let's look at the numbers for a moment. According to recent data, the average loan rate for a used car in the US is now around 11%. That's up from about 8% just 2 years ago. On a $25,000 used car, that difference adds up to thousands of extra dollars in interest over the life of a loan. For many families, that's enough to make them think twice. On the company side, CarMax's lower profits suggest it's getting tougher to make money on each sale. With prices dropping, their profit margins are thinner, but operating costs like staffing, advertising, and maintaining huge lots haven't shrunk. That's a squeeze from both sides. This earnings miss is also a signal for investors. When a company as big as CarMax stumbles, it can spook the market. Investors worry that if CarMax is struggling, smaller dealers might be in even more trouble. And since car sales are often seen as a barometer for consumer confidence, weak numbers here may hint at broader economic anxieties. Historically, the auto market tends to reflect the economy's health. When people feel confident about their jobs and finances, they're more likely to make big purchases like cars. When uncertainty rises because of interest rates, inflation, or job market worries, sales slow down. We saw something similar after the 2008 financial crisis. Auto sales dropped sharply, and it took years for the market to recover. Looking ahead, CarMax faces some tough choices. Do they keep lowering prices to attract more buyers, risking even lower profits? Or do they hold prices steady and wait for the market to rebound? It's a tricky balance. Meanwhile, other players like online-only retailers and local dealerships are watching closely and may adjust their own strategies in response. There's also a tech angle to consider. CarMax has invested heavily in digital sales and online car buying tools. hoping to appeal to today's internet-savvy shoppers. But even with these innovations, the fundamental challenge remains. If people aren't willing or able to buy, all the fancy tech in the world won't move cars off the lot. For everyday investors, the big takeaway is this: earnings reports like CarMax's aren't just about one company. They offer clues about consumer spending, credit conditions, and where the economy might be headed next. If you're investing in retail, autos, or even broader market funds, pay attention to signals like these. So, to wrap up, CarMax's tough quarter is more than just a bad day for the company. It's a warning sign about shifting consumer behavior and the ripple effects of higher interest rates. Whether you're car shopping, investing, or just keeping an eye on the economy, this is a story worth watching. If you found this breakdown helpful, don't forget to like, comment with your thoughts or questions, and subscribe for more insights. And here's something to ponder. Will lower prices eventually bring buyers back, or is this a sign of a longer slowdown ahead? Only time, and perhaps the next earnings report, will tell.